So we launched the fund in March of 2012, and we set out to deliver 8 to 10% annualized returns to our investors. We're now at the end of our 10th month in December, and we feel we've done that. We're actually at the upper end of that range. And more importantly, we've managed to deliver on our promise of low volatility returns and on capital preservation. So we're very pleased with how the fund has gone so far.
Equally, from a business perspective, we're pretty excited at how 2012 has gone. We launched the fund, as Andrew mentioned, in March with the backing of CI and a pretty strong partner, and we've been very pleased at how that partnership has developed through the year. We recently took on a sub-advisory mandate from CI at the beginning of December and are finishing out the year with just over $200 million in assets and lots of opportunities for growth in 2013.
The main difference in how we manage fixed income money is that we hedge interest rates and we focus on credit risk. So really what we're doing for our investors is investing in corporate bonds, we're hedging out interest rate risk, and we're really looking at relative value to deliver returns. And we're looking at the inefficiencies of the fixed income market and how we can exploit that to deliver low risk, high quality returns.
Well, we've had a bull market in fixed income for the past 30 years. Increasingly now it's difficult with where rates are for people to achieve their traditional objectives in fixed income, preserving capital, having a low volatility strategy, and producing any income. And now more than ever, we think that active management is what people should be focused on with fixed income.
So any fund that hedges a big portion of its risk really needs to use leverage in order to generate returns. And what we're doing is we're reducing the volatility profile of the types of investments we're making, and then we're leveraging those returns to deliver solid performance. So you have to differentiate between a fund which is levering up to take directional risk and one which is levering based on using sophisticated hedging strategies to minimize volatility.
I think it's important to differentiate between bonds and fixed income and different types of instruments that people look at for fixed income. It's clearly now where we're in a situation where rates are at historic lows and the ability to achieve the substantial objectives, again, that people are looking for in fixed income with interest rate strategies is going to be very difficult. And so when we talk about bubble, really what we're talking about is interest rate sensitive strategies that are typical index-based, government, provincial type strategies that have a lot of duration and are susceptible to rising interest rates. And as such, when we look at what we do at Lawrence Park in a credit fund where we're hedging away that interest rate risk, we think that we provide a very viable option for people to stay within fixed income, but hedge away and preserve their capital while still maintaining an ability to generate income.
The central banks are clearly in a holding pattern when it comes to interest rates. Bernanke in his latest speech was talking about basing an interest rate decision on the unemployment rate. And that's a long way off before we see higher rates, especially in the US. Canada, it may be a little bit sooner. We know that there is concern around the debt burden at the consumer level, and so there's a little more pressure to raise rates. But I think the key thing that investors have to focus on is that term interest rates in a fixed income portfolio are very different to the type of short-term rates that the central banks are setting. And even though Bernanke is talking about low rates for an extended period, he's really talking about short-term interest rates. And there's no guarantee that the types of active quantitative easing that the Fed has been practicing for the last couple of years will continue all the way through 2013. So I think investors need to be prepared that interest rates can be volatile. They'll be susceptible to the economic releases we get throughout the year and what type of growth we see. And so you really need to be thinking about what your objectives are in fixed income, and as we've talked about, find an active manager to protect you against a falling bond environment.
It's, yeah, we do get
Where are we called lines?
Yeah. So coincidentally or not, it's where Andrew and I both live, and we're the co-founders of the company. And when we founded the company in March of 2011, we were considering a number of different names, and we really look at the type of profile of the products that we're creating as being low volatility with growth potential. And really, we look at that neighborhood, that leafy neighborhood in Lawrence Park, the tree symbol as being one of stability with growth, is really matching, the ethos of what we're trying to do and the type of products that we're trying to bring to investors in Canada.
Yeah, there's lots of sort of sexy or funky names that we could have come up with, but really, for us, we're doing what we're doing because we're in a neighborhood in Toronto where we want to raise our kids and our families. We're trying to offer them the kind of protection when it comes to their lifestyle, and we think that's what our investors are looking for. And so we felt that the name really represented the kind of values that were consistent with what we were trying to deliver.
And I guess on a closing note, we'd like to thank all of our investors and followers for your support during our first year, 2012. As we've discussed, it's been a pretty good year for us, and we thank you for that support and wish you the best for 2013.
Yeah, I hope everyone has a happy holidays, and we look forward to speaking to you again in the new year.